Hi, morning everyone. Welcome back to Monica Payne. Aiman here. Right, so for yesterday, looking at the S&P 500, well, it closed higher, somewhere around 0.19 or 0.2 percent on Monday session, successfully breaking above the 7,400 level and extending its record high rally. So I think this bullish move was mainly supported by the strong buy interest in the tech and also AI-related stock after several, Wall Street firms raised outlook on the AI demand and also the earnings growth as well. At the same time, sentiment also improved after the U.S. economic data showed that the economy remains resilient, easing fears for the near-term slowdown. So I think investors were also encouraged by the expectation that the Fed could move closer towards the rate cut later this year, right? Which continue to support the risk appetite as well. So moving forward, I think sentiment remains positive as long as the index to stay above this 7,400 level. Right. So, if you take a look at this China A50 futures, well, it closed sharply higher yesterday, around 1.61%, with sentiment improving strongly across large cap Chinese stocks as well. Right. So, the recent rally was mainly driven by the optimism over fresh China stimulus expectation after reports suggest that Beijing is considering additional support measure to stabilize those growth and also on the property sector. At the same time, I think stronger regional markets and improving risk appetite also help to lift buying momentum across those China equities. Technically, the strong rebound triggered momentum buying and short covering as well, helping the index to push higher into the close for yesterday. And moving forward, I think sentiment may remain positive if the expectation for further policy support continue to intensify. Right. So now taking a look at the WTI graph futures, well, not surge, but a rebound. I would say rebound higher to 3.9% on Monday session, with also sentiment turning strongly bullish after the fresh geopolitical tension for the war. Right. So yeah, the rally came after Trump see that the Iran ceasefire is on live support following the report that Tehran rejected the latest US counter proposal, right? So this raised concern that tensions could escalate again and disrupt the global oil supply further. So as a result, the market quickly priced in a higher risk premium, especially around the Hormuz Strait, uh, you know, and also at the same time, I think the short covering and also bargain hunting also accelerated at for the uh, bullish momentum, right, after the recent pullback in the oil prices. So I think me personally looking ahead, the oil prices are expected to remain volatile with upside bias as long as the tension remain unresolved. So yeah, we remain unchanged with our positive trading bias, aiming for this 100 and also 110 resistance level. Right, so to look at the Malaysia market, well, the LCI closed slightly lower by around 0.16%, while the FKLI managed to rebound about 0.26% yesterday, suggesting that the futures sentiment was slightly better than this KLCI cash market, right? So yeah, I think for KLCI, the weakness, right, was mainly due to the profit taking in the heavyweight stocks, especially after the recent rebound for the past few weeks, right? And also at the same time, I think sentiment and cautious following concern over the global trade tension after fresh headlines from US weigh on the regional market, right? However, FKLI managed to recover as traders started positioning for their potential technical rebound after the uh, uh, recent weakness, right? So looking ahead, I think the market may remain in positive territory in the coming session, targeting for this 70.90 followed by 18.20 resistance level. Right. So yesterday's movement, seen after the weakness in selected index linked plantation and also industrial counters weighed on the benchmark despite the broadly positive, market tone. Right. So yeah, overall sentiment remains positive, constructive. Right, with strong buying interest in across healthcare, tech, and also those utility stocks led by YTL, and for a glove we got Hata, Top Glove, and several mid cap growth names, resulting in the market breadth that stayed firmly in green, right? So yeah, if you look at this sentiment meter right here, this is clearly an opportunity for us, right? I mean, the index remains on a neutral side, and at the same time, I think if we were to look at the box below right here, uh, yeah, gainers have outpaced the losers by 562 to 558. So today, I believe we have a lot of things. I mean, in terms of buying opportunities that we can benefit from, lah, right? And yeah, I think the healthcare and also glove related stocks was higher yesterday, mainly driven by the renewed antivirus concern, which sparked defensive buy interest over the sector as well. And investors rotated back into the glove counter on expectation of potential demand recovery sentiment, which similar to what we have seen during those pandemic COVID-19 years, right? And I think on the tech front, semicon and also those IC design related stocks also saw strong momentum yesterday. This is came after the Ministry of Economic announced plan um, to strengthen, right, to strengthen Malaysia's national IC design capabilities through a strategic partnership with ARM, right? So yeah, I think following the announcement, stocks such as Opstar and those, I mean, their peers attracted strong buy interest as the market anticipates for more opportunities in the chip design, talent development, and also high value tech ecosystem expansion. So I believe for those glove stocks, right, continue to monitor and can include in your watch list as well, like Top Glove, Harta, Kosan, Supermax, right? And for the tech play, I think yeah, we can take a look at Opstar. We have Nation Kid as well, Inari, and also Skychip. Well, yeah, talking about Skychip, right? Our analyst Meng gave a fair value of RM1.41, which represent 60% upside from the IPO price of 88 cent level. So I believe that the positive momentum to follow through during the listing day, which tentatively on 20th of May 2026, which is I think somewhere next week, right? So looking at our Malaysia trading stock. So we got four stocks today, right? So firstly, we have Harta Lega or Harta. So the stock is on its breakout formation higher at RM1.30 level on a strong volume. So with that, we expect the momentum to keep bullish and the stock able to propel higher to test the next resistance at RM1.45, followed by RM1.60 level. So if the stock to clear below RM1.15 level, this could reverse the course and trend lower below the 21-day moving average. And next we have THMY. THMY stock is experiencing a breakout as well at RM1.35 level. So if the stock remains in a positive bullish movement, we expect for the price to reach RM1.45, followed by RM1.55 level. Keep an eye at RM1.25 for any attempt of reversal. And thirdly, we have WCT right here. So the stock is now forming a pending breakout formation at 48 cent level. So with that, we expect the momentum to remain bullish and the stock able to propel higher towards this 52 cent level. Second resistance is at 56 cent level. So keep an eye at 44 cent support for any reversal movement. Right, and lastly, we have Powell, and the stock is on its breakout formation as well at 77 cent level after it breached this level. Right, so with that, we continue to expect the stock to might propel higher towards 82 cent, followed by 87 cent level. So for now, the support is back at 72 cent level. So we have four breakout stocks, which is Hatta Lega, THMY, and also Powell, and one pending breakout stocks, which is WCT. So yeah, keep an eye and take a look. Maybe you can put it in your watch list as well. Right. So I think talking about the THMY, since we have THMY in our trading stocks, right? So just wanted to share with you to compare side by side with KL Tech, right? This is Bursa Malaysia Technology Index, which is the the blue line is the THMY price movement, and the candlestick chart is the KL index. So I believe there's still some upside to propel higher for THMY, since the stock is follow positively to the index after the price may breach the consolidation zone level, right? So do keep an eye at these four stocks, including THMY as well, right? So I'll stop here and pass the floor to Leng for her updates, right? Thanks, everyone, and happy trading.
Yeah, hi, good morning, everyone. Today we're going to talk a little bit about the plantation sector, where we've got a report out today with the stats for the month of April, as well as an earnings preview, where we'll talk about what we expect for the first quarter of 2026 in terms of results. So maybe let me start with the earnings preview. So if you look at the earnings for the first quarter of 2026, we expect to see a very similar trend for both the Malaysian and Indonesian centric planters, where the first quarter earnings should be moderating quarter on quarter, really dragged by the weaker seasonal output, given that the first quarter is a low seasonal month. And this is despite the fact that CPO prices was relatively stable. So if you look at CPO prices, it was relatively flattish. FFB production for the Malaysian planters under our coverage fell about 21.6% month on month. And for the Indonesian planters, we expect that it also fell similarly month on month, quarter on quarter, sorry, about 18% quarter on quarter. So definitely first quarter should be lower than the fourth quarter. But versus the first quarter 2025, we also expect to see a reduction in year-on-year earnings for both the Malaysian and Indonesian centric planters. Again, where we would see, and this would be mainly coming from these lower ASPs, where CPO prices actually fell about 11% year on year, and PK prices fell about 5.7% year on year during the same period. On a combined regional basis, we see that FFB output across all planters under our coverage grew about 2% year on year in the first quarter. Going into 2026, we expect the production growth to remain broadly constructive. Some of the companies with a bigger growth would include Ta'an, First Resources, IOI, and NSSS. In terms of downstream, we're expecting to see downstream margins be a bit weaker quarter on quarter for the Indonesian listed planters, given that the tax differential was wider during the quarter. Conversely, we should see Malaysian downstream planters also therefore benefit from that. But that being said, with the unexpected sharp spike of CPO prices in the month of March, that could upset the balance somewhat with, especially with trading activities. So overall, we have already seen some companies report results. I think most of the 6 out of the 6 companies that have already reported results and that's mainly on the regional side of things. 4 actually came in below expectations, and that would include SDG, Wilma, NSSS, and LSIP. 1 came in above, and that was Astra Agro, and another one came in line, and that was SOP. For the rest of the companies, we expect relatively broadly, we expect most of the companies to meet expectations, broadly meet expectations for the first quarter. Although one company that could disappoint could be TSH Resources, where FFA production was a lot weaker than expected. Going to second quarter, however, we do expect earnings to recover quarter on quarter, given that output is definitely stronger and CPO prices definitely has also improved. Moving on to the statistics, if you look at the production numbers for the month of April, we saw a market increase in production month on month, up about 18% month on month, bringing year-to-date April output growth to 6.7%. The numbers in Indonesia is only currently up to February, but still seeing a similar pattern of good growth year-to-date February of 29% year-on-year. So we continue to believe that production could be heading to an early seasonal peak this year, barring any sort of unforeseen weather circumstances. In terms of exports was down 14% month on month during that month of April, bringing year-to-date export growth to 25%. And this month-on-month retracement occurred despite the fact that CPO was trading at an average of a large discount to soybean oil of $377 US per ton versus 316 in the month of March. But we think that this potentially could have been due to demand destruction rising from the higher war-led prices, as well as the comfortable inventory positions in the key importing regions. If you look at MPOB stock levels, we don't have numbers for April as yet, but as at end of March, we already see that most of the countries are holding higher than average, historical average stock levels for palm oil, which is why we saw that temporary pause in replenishment activities. So if you look at stock levels then for the month of April, we saw it actually increasing this month to 2.31 million tons from 2.27 last month. And that's obviously because production was increased, exports was down, and therefore we see stock usage ratio now at 11.1%, which is still above the historical average of 10%. Going forward, we think that we could see some improvements in exports in the month of May, as global buyers will be stocking up ahead of Indonesia's transition to B50 in July, Malaysia's transition to B15 in June, and also the fact that the price gap between CPO and soybean oil has widened significantly now to about $504 per ton. So we do think that there will be some increase in exports in the month of May, and as a result, we would probably see flattish inventory in the month of May, as rising demand would offset the higher output trends. So overall, we are keeping to our tactically positive trading view on the sector, with our CPO price assumptions at 4,004 for this year and 4,003 for next year. As mentioned, we do expect second quarter earnings to come in better quarter on quarter. Inventory levels should remain relatively stable. So let me stop here. And so maybe our top picks, let me end with the top picks. We still like in Malaysia, we still like JPG, SOP, IOI. And regionally, we like London Sumatra, First Resources, London Sumatra and First Resources. So let me stop here and pass on to the next speaker, Meng Horng. Thank you so much.
Thank you, Leng. So we also have a report on the small cap, where we compile the results from our selections in our 2025 jewels, in conjunction with our launch of our new book 2026 jewels tomorrow. Now, together in these reports, we also highlight the strategy in a small mid-cap space. So in terms of our jewels 2025 selections, I think despite the overall landscape of reciprocal tariff, heightened geopolitical risks, as well as a global supply chain volatility, Our 20, top 20 jewels 2025 actually outperform, both the FBM 70 as well as FBM small cap index with a value weighted holding period return of 20.1%. This is since our launch date of the book on the 14th of May 2025. I think this is a big dedication from our team in the stock selections with meticulous analysis as well as stringent corporate governance screening. Now, overall, the portfolio or the 20 stocks are comprised of 10 gainers, outperforming also the breadth of FBM small cap, and winners hailed from various sectors such as consumer products, healthcare, industrial products, renewable energies, all benefiting from sector tailwinds, as well as some company-specific catalysts. We do also have a corporate exercise that lifted the overall share price performance, such as Apex Healthcare, which was privatized earlier. Now, as for the strategy for the sector, we believe the small mid-cap space are likely to regain investor traction, supported by attractive valuations relative to the long-term average, as well as a favorable risk-reward profile, given that our base case actually assumed a short-lived conflict in the US-Iran war. Now, this space could be poised for a stronger performance in 2026 based on historical trend. I think we have never seen 2 consecutive years of downtrend in the SPM small cap, at least for the past 10 to 13 years. In fact, both KLCI as well as FBM 70 actually has staged a solid recovery, both delivered a 4.8% gain year to date, as well as 9.9% gain year to date for FBM 70. Now, however, I think the FBM small cap index is still lagging, in terms of the performance, registered a negative 0.2% year to date. We have seen, the recent sentiment has restarted back in April, and it actually drive, the entire, index as well as the Bursa Malaysia to a higher ground. But interestingly, if you look at regionally, if you were to track MSCI Malaysia Small Cap Index, it is on the back foot compared to most of our regional peers, or except only for Thailand and Philippines. So if you were to compare with Taiwan, even Korea, Hong Kong, Indonesia, Singapore, we are actually lagging behind. And we believe this lag is a precursor to a significant re-rating. Now, if you look at market breadth within the FBM small caps, it's actually showing an early signs of recovery. We have seen the trading activity remain robust despite the topsy-turvy outlook or the market sentiments over the past 4 months, thanks to ample domestic liquidity as well as a regional interest. I think most importantly, the valuation gap is actually at a very pronounced level at about 5 to 6 times PE discount to the FBM KLCI, and we deem this as attractive. Again, this is supported by our earnings forecast, in this space of about 10.8% in 2026 versus a merely 5.8% for the FBM KLCI. Moreover, both indices actually trading below their respective 10-year mean valuation spread compared to the KLCI, reinforcing a very compelling risk-reward setups. Now, we advocate a balanced strategy across value, growth, as well as the yield stocks, preferring companies offering earnings quality, cash flow generation, particularly for those well-positioned to navigate the imminent cost pressures as well as demand uncertainty in the current operating landscape. We also think that stocks that could benefit from the structural growth trend as well as the demand recovery, the favorites. And our topics are actually from consumer, constructions, industrial products, oil and gas, technology, property, as well as in energy. And the key risks to our call will be on protracted war situations. And if the war were to continue, prolong, and escalate, it could lead to economic recessions, and that also resulting in a very high input cost as well as a slump in demand for most cases. There are also, the small cap specific risks such as liquidity issues, as well as a higher, ESG related risks to watch by. So I think that's all from us today. Thank you for listening, and we hope to see you again tomorrow.